Welcome and thank you for joining. Today, we are not just simply talking about markets, but also about human tragedy, loss of life, and widespread destruction across Iran, Israel, Lebanon, and the wider Gulf region. In this presentation, I want to show how a geopolitical shock rapidly evolved into an energy shock and why that matters for investors. Let's start with how these events unfold. You can't lose if you don't have a goal. Unfortunately, markets don't have that luxury. What started as a military operation with vague and changing objectives very quickly drifted into something else entirely. While Donald Trump may have had a military strategy, there were clearly no consideration given to the oil market, and that is the problem. Because when conflicts lose focus, they don't end. They spill over. And in this case, they spilled straight into energy and, ultimately, the global economy. On paper, the US won. Total air dominance, senior regime figures eliminated. But in an asymmetric war, military victory doesn't end the conflict, it redirects it. Iran's strategic strength does not lie in matching US firepower. Its remaining leverage lay elsewhere. It lies where it sits, from the Persian Gulf. Iran has two options. The first is targeting regional assets, US based in the region, oil infrastructure and export facilities. But the second is far more powerful. Closing the Strait of Hormuz, a narrow maritime choke point between Iran and Oman. At its narrowest point, the physical gap between the two countries is only 24 miles. Navigable lanes are only 6 miles wide, and around 20% of global oil supply flows through it every day. That makes shipping uniquely vulnerable to an Iranian blockade. And that disruption is already visible. Since the conflict began, shipping traffic through Hormuz has fallen. While the US fights Iran militarily, Iran, by threatening Hormuz, is effectively fighting the world economically. This is where military victories stop mattering and leverage begin. Closing the Strait of Hormuz doesn't delay oil, it removes it. We estimate that around 7 million barrels of oil per day vanish from the system. At that point, markets are no longer pricing risk, they're pricing scarcity. And once supply breaks physically, the shock doesn't stay in oil. The vast majority of Gulf oil export is shipped to Asia. As such, Asia feels the shock first. But the Strait of Hormuz is critical to far more than just crude oil. It is a key artery for gas, refined products, petrochemical, and fertilizers. When shipping through the strait is disrupted, the impact spread well beyond energy markets. In other words, this is not just an Asian oil shock, it is a multi-commodity shock moving through the entire system. The reason oil shocks are so persistent is simple. Oil is not just a source of energy, it's a core economic input. Oil sits at the base of almost every supply chain. It touches almost everything we consume, often long before people realize where the pressure is coming from. Higher oil prices raise the cost of fertilizers, which feed directly into food price. They increase the cost of plastic, pharmaceutical, and consumer goods. Even when oil is not visible, its cost is already there, like in cosmetics. This is why oil shocks don't stay confined to petrol stations or airlines. They work their way through the system layer by layer until they show up in everyday price. This is why oil functions like a hidden tax. This episode is not comparable to the oil crisis of the 1970s. Back then, economies were far more energy intensive. Supply was less diversified, and policy frameworks was slower and more rigid. Today, oil represents a much smaller share of economic output. Energy consumption per unit of GDP is lower, strategic reserves are larger, and monetary and fiscal responses are faster and more flexible. That doesn't mean that there is no impact. Higher oil prices do put upward pressure on inflation. It can weigh on growth, particularly if disruption persists. Our best case is that oil price will remain elevated but contained close to 2024 level. Markets themselves are already pricing a relatively swift normalization. In short, this is a shock the system can absorb, not a return to 1970s style stagflation. This is where it's important to separate short-term disruption from long-term change. This episode was a shock, but not a full-blown crisis. The disruption from the Strait of Hormuz was severe, but manageable for the global economy. What matters is not temporary dislocation, but what it signals. The real takeaway is globalization aspect, including in energy security. Countries are accelerating their diversification of energy source, driven by resilience rather than climate change objective. This reflects another deeper shift. US exceptionalism has reached its maximum, with China being on the ascent, particularly in the global south. The world is moving toward a more multipolar world. That is the structural change, not a cyclical one. The shock will fade, but the shift won't. Energy, trade and geopolitics are now about resilience in a multipolar world. As I've talked about investment, I must remind you that capital invested is at risk and future performance cannot be guaranteed. If you have any question or comment, please contact your financial advisor. Thank you for your attention.